Hey Canada, happy Thanksgiving weekend. I've been involved in a number of discussions online recently, people looking for answers about the tax-free savings account. And so that is one of the things we really have to be thankful for here in Canada. The tax-free savings account is a great investment and tax planning tool. And I just want to share with you a couple of features about it based on the questions that people were asking. So, first off, what's the deal? Okay, tax-free savings account. As the name says, no tax, tax-free. What is it that's tax-free about a tax-free savings account? Well, there's two features. One is, as your money is growing inside your tax-free savings account, as your investment is building up over time, there is no tax being paid on that. So your investment is just growing and growing and growing. And when you go to withdraw money from your tax-free savings account, which by the way, you can do at any time, when you withdraw money from your tax-free savings account, and by the way, don't do that if it's your retirement money, no touching the retirement money. When you withdraw money from your tax-free savings account, you don't pay any tax, it's tax-free. Let's compare that with an RRSP, which has been a staple of Canadian investing for decades now. And when you make an RRSP contribution, you are able to take a tax deduction. And what people are kind of addicted to is that tends to generate a tax refund. But that's really just a symptom of poor planning. If you're planning on contributing to an RRSP, you should be arranging your taxes in such a way that you're not paying that money up front and getting a refund. Don't let that refund seduce you. And I'm going to talk about the difference in the tax treatment of these on the back end in a couple minutes. Okay, so the tax-free savings account is governed by what's called contribution room. That is the amount that you are able to contribute or put into your tax-free savings account. It all depends on the year in which you turn 18. That's when you begin accumulating contribution room in your tax-free savings account. So if you were born in 1991 or earlier in Canada, you began accumulating that contribution room then, when you turned 18, and you've been contributing it since then, and you will have accumulated the maximum amount, which currently is $57,500. That's the 2018 amount. And each year, that contribution room goes up. Currently, it goes up each year by $5,500. So if you were born 1991 or earlier, in 2019, your contribution room limit is $63,000. That's a total amount that you can have contributed to your tax-free savings account over the life of the plan. Now, a couple things. You can find out how much your contribution room is. If you were born after 1991, there's all sorts of stuff online. But if you want to find your specific amount, you can go to the Canada Revenue Agency My Service site and log in with your identification, and you will be able to get the amount that you have accumulated in contribution room. Also, starting with the 2017 tax year, so when we started getting our notices of assessment in 2018, you should see on your NOA how much contribution room you have available in your tax-free savings account. Okay, so next, let's have a look at what happens if you take some money out of your tax-free savings account. Now, if you withdraw money from your tax-free savings account, of course, you don't pay any tax on it. However, you do get that contribution room back. So what happens is, let's say you've accumulated a bunch of money in your tax-free savings account and you withdraw $5,000. You get that $5,000 in contribution room back. You can add back in that $5,000 in the future. But you don't get that contribution room back until the next calendar year. So if you withdraw $5,000 in March, that $5,000 is going to be added back to your available contribution room January 1st, starting the next year. All right, now here's where the rubber really hits the road. The thing that you really want to be paying attention to when you're building up your investing plan for your retirement, and I know people really focus so much on how much should I be putting in, what am I investing in, and those are both essential and critical questions. But another critical question is, what's going to happen when I go to withdraw this money? How am I going to be taxed? It really depends how you're taking it out and what vehicle you're taking it from. So let's look at this example. Let's compare a tax-free savings account and an RRSP. If you contributed $5,000 a year to a plan, either one, for 25 years and got a 7.5% average rate of return, you're going to have accumulated somewhere in the neighborhood of $340,000. So that's what your investment would have grown to. Fantastic, great job. Glad you did that. So now you're starting to withdraw that money. Now, if you take all that money, if it's all in an RRSP and you withdraw that money from an RRSP over your retirement years, if your marginal tax rate, or if the tax rate you're paying on that RRSP withdrawal is 22.5%, you are going to pay a boatload. Let me look at my number here. You are going to pay about $76,000. So that is going to go all the way up to here. $76,000. $76,000 of your hard-earned invested savings gone to the tax man in retirement. Now, if instead that money was inside an RRSP, you would only have paid up front, mind you, you would have paid up front $28,000. So, $28,000 versus $76,000. What that means is you are paying 2.7 times as much tax with the RRSP. 2.7 times as much. Now, let me caution you. This is a very simplified illustration. You need to make a very clear and calculated understanding of how you're going to withdraw your money from your RRSP if that's where you've put it. But this is the core reason why for almost all Canadians, it's a much better idea to fill up your tax-free savings account first before you consider putting money into an RRSP. And even at that point, it won't necessarily make the most sense to put it into an RRSP, though it may. It depends very much on your individual circumstances. And you need to get quality financial advice either from a financial advisor or an accountant regarding that. Now, one of the things that's most critical is like, oh, RRSP bad, tax-free savings account good. That's not what I'm saying. I'm saying tax-free savings account great, RRSP may be good. And the reason is the RRSP is built on the notion that you are going to be in a substantially lower income bracket and therefore tax bracket in retirement. That is, when you're working, you're going to be making this much money, and when you're living in retirement, you're only going to be making this much money. What we're finding is for a lot of people, that's not how things are sorting out. And so they're getting hit with these nasty tax bills when they're forced to withdraw their money from their RRSP in retirement, because you are compelled to begin withdrawing money from your RRSP at a prescribed rate, prescribed by the government, at age 71. And so they are always going to get their pound of flesh. They're always going to get their tax money, the government. So, key things to think about. Bear this in mind. Probably for you, the best bet is to fill your tax-free savings account first and then think about putting money into an RRSP. We have a whole other piece that's just specifically about the tax-free savings account versus RRSP. Get in touch with us. We'll be happy to point you at it. Hope you have a great turkey weekend. Happy Thanksgiving.